Okay, let's answer some questions from the last market outlook. First one, would love a little history lesson if you can remember, with you having lived through the dot-com era and now seeing similarities to the hardware companies today. Was there a single name back then that was the only name getting all the attention like NVIDIA is now? No. The big difference between then and now is then all the infrastructure had to be built. The internet really was in its infancy and all the infrastructure had to be built. And it opened up a lot of opportunities. So a whole bunch of companies started appearing that was going to take advantage of the internet. Today, the infrastructure is mostly built except for the GPUs. So it's mostly there. You don't really need to build out a lot of infrastructure at this point for the, I guess, just the flow of the data. Back then, you had to create all of that. It also concurrently happened at a time when the telecom industry was being deregulated. So you had a bunch of new competition coming in at the same time that there was this new thing called the internet that would be moving data around. So you can imagine the hype around those. And for building out the architecture of the internet, it was CPUs, it was equipment manufacturers, it was the cell phone companies, Nokia, Motorola, Intel, Dell, and then of course all the startups in the telecom space. So it was more broad than it is today. Let's see, could you do a little series building a small part of a PF by identifying stocks and use options to bring costs virtually portfolio? In the portfolio construction series in the applied level, I do show you how to use options on securities, and it just is a matter of discipline. It's a matter of using options consistently again and again and again to lower that cost. And I believe in the options, applied options, I show you how to do one with, I forget the name of the company that I was doing one with, but I sold puts on this company knowing that I had very low conviction on it, but I was doing it to show how you could work your way out of trouble. And in doing it, lowering your average cost. It really is, if I show you, if you see it done 1 month, it's just, like the shampoo bottle says, wash, rinse, repeat. My idea, contribution cap for RSP equals 32K a year. Year one, take 25% of the cap, bring it to a zero cost position on an RSP. So you're limited in an RSP to covered calls, and you have to get permission. You have to ask your broker for permission to do covered calls in an RSP, and you're limited to just doing that. But yeah, it is selling calls, 20 delta calls, 15 delta calls. You don't want to get aggressive on it, but selling calls is an income enhancer. It's been a strategy, an income strategy for a very long time. But who cares in the RSP? Who cares about getting your cost base to zero? Right? It wouldn't matter if you get your cost base to zero, because every dollar you pull out is taxed at whatever your tax rate is going to be when you pull it out. There is no advantage in an RSP to earning low tax income or trying to get your tax base down as low as possible. There is no advantage in an RSP. So in an RSP, it really is just an income enhancer. Could you do a small video about how to find good box trade candidates to use to over-contribute to a TFSA? Don't know that I would say that they're good candidates to use as much as good market conditions to do it under. In bull markets, 90% of stocks go up. So the idea of over-contributing is to buy something in your TFSA that is going to go up. Now you may think, well, why not just do that? What am I messing around with my taxable account for? If you're trying to identify stocks that go up, isn't that enough? Won't my TFSA grow? You could be wrong. So let's just imagine that this box is your whole portfolio, and this is your TFSA over here, and this is your taxable account. What you want to do is keep the size of the box the same. It's just you want to shift this over to here and make the TFSA larger, but you're limited to a contribution. Well, I think it's $6,000 or $6,500 a year. And what you don't want is to speculate. You know, yes, you want to buy stocks in your TFSA that you think are going up over time, but you could be wrong. And this is what we want to avoid, which is why the box trade works really well. You take a long position here, you take a short position here. In a bull market, stocks tend to go up. So you will increase in value over here, and you'll lose by the same amount there by keeping the size of your portfolio the same. The end result is that your TFSA sleeve is just bigger. You've moved money into your TFSA, and you've generated a short-term capital loss over here if you have any other short-term capital losses. And the value of that short-term capital loss will far exceed the borrow cost. Sorry, the borrow cost that you paid, and the borrow cost is part of your loss as well. And that can offset some of your gains, and you're increasing the size of your TFSA. So, sorry, you could buy stocks in your TFSA that you normally would never buy because the volatility is too high, and you would try to over-contribute there. You do the opposite for your RSP. So here's your RSP. We know that when we take money out of our RSP, it's taxed as income, and you have your taxable account here. What we'd like to do is to buy losers, and you go long the loser over here. You find a stock that has no reason for existence, and you go long here and you go short over here. And if you're lucky and right, the stock will drop in value, and since you're short, you'll make the money there by keeping the value of your portfolio, your whole portfolio, constant, but just reducing the size of the RSP sliver in your portfolio. And you have a capital gain over here, whereas here you wouldn't be taking it out. So you're taxing it at a capital gain rate and not your income rate. Now, if you're wrong and it goes up, well, then this goes down. You don't lose anything. You just have more in your RSP. You just over contributed to your RSP all of a sudden. And then you're better set up for retirement, but you've moved some of your taxable into your RSP, so you tend to over contribute. The end result here is that we do have to find something going up and something going down, and just because we think it's going up or going down doesn't mean the market's going to agree with us. But if it does, it's an effective way to over contribute to your TFSA and to decrease the size of your RSP. But I'm telling you, you're going to need separate brokers to get this done. So you'll need one broker over here, and maybe you're with TD over here, so that it doesn't go past their compliance department. Do TLT dividends in a taxable account subject to withholding tax? Yes. In a taxable account, yes. 15%. If data center is the store, it seems the CPU manufacturers are not in the same hike. For the data center, you need both CPU and GPU, but the sales of Intel and AMD, it does not add up. AMD data center sales 64. Okay, I see what you're saying. So I want you to think about it in a slightly different way. Let's say, let's draw two boxes here. And we'll say that this is, I don't know, a warehouse, and it's filled up to here. So you still have all of this capacity that can be added before you have to build out more warehouse space. But a condition of getting in the warehouse is you must first have some quality to your product, and that service is full. So you keep bidding up the value of the quality of that product because you can't get your product in this warehouse until it has this quality. Once it has this quality, it heads over here. But there is so much capacity that no, you don't have to actually build out more capacity here as this fills up. So these are your GPUs, these are your CPUs, and that's probably as best a picture as I can draw as what's going on. What role does the term premium play when you think about the likely trajectory of long-term yield? Term premium 10-year zero coupon bond from Fred has been negative since the end of last year, sitting around zero. In the midst of it, you reason that long-term yield is not likely to go any higher, but even go lower. Well, the term premium is light. It's low. It's really dependent on the shape of the yield curve as well. You have an inverted yield curve, which might contribute to the calculation that the term premium is zero or negative. What would it be under normal times? 15 basis points, 20 basis points maybe? I don't know. I don't see it as the big thing. If you have a 25 basis point rate cut, I think that overwhelms any term premium that could be there. What's one thing you love about Costa Rica? The weather, I guess. You know, if I had to think of something off the top of my head. I realize I don't understand how to measure U.S. liquidity. I thought about money supply. That's it. Fed balance sheet, euro dollars, deficit spending. Finally realized I can't tell if liquidity is increasing or decreasing. It's just simply the amount of money supply, the amount of money available. If you're talking about liquidity at an economy level, at an aggregate level, that's it. It's just M2. Make matters worse, commentators make statements on changes in liquidity and they rarely explain how they are calculating it. So let's say I have an in-ground pool and my skimmer is right about here. Your water level should be about there on your skimmer. If your water level is all the way up to here, you have to lower it. So lowering it removes liquidity. I could lower it to here and I still have excess liquidity because I got to get it down to here. So just because we're lowering the amount of money in the system, it does mean liquidity is contracting, but it could be contracting from such a very liquid position that the contraction still results in a liquid market. But if the water level were down here, I got to raise that quickly because that is more damaging. I got to raise the water quickly. I have to add water. Water's liquid. I have to add liquidity, right? That's all it is. It's just the level of M2. Is there a good website on U.S. liquidity? I don't know if there's a good index or website. I don't know. Found this liquidity equals Fed balance sheet. Unless the TGA balance. Well, that's true because TGA is not available in the economy. Less reverse repos. Because you've given... Yeah, you've taken money out of the system. You've given securities to the counterparty. Yeah, in a rough sense, sure. I think we could get less fancy with all of that and just say, well, let's just look at the level of reserves. I think we could just, do it that simply. Level of reserves and well, that is the existing liquidity in the system. Repos are usually zero unless the Fed needs to add liquidity. Then it could increase repos. Yeah. Oops. Can you please explain the mechanism and purpose behind DHI using repurchase agreements to sell their mortgages for cash? A repo is a financing tool. It's not used to sell mortgages. It's a financing tool. So what usually is done is you have to warehouse these mortgages somewhere, and much like inventory, you might need inventory financing. So you have assets and liabilities, and you have mortgages as your assets, and maybe you need a certain size of mortgages before you can sell them off, and you're filling this amount of mortgages. Well, you're going to have to finance your inventory. That's what repos will do, until you get to a point where, okay, it's big enough and significant enough that we can sell it to a counterparty, and that pays off all the repos. So think of it as inventory financing. It might be 30, 60, 90-day inventory financing, but a repo is a financing mechanism, not a means for selling securities. Regarding the Fed's balance sheet runoff, I don't understand how the balance sheet shrinks when they let securities run off. Presumably, if they have a treasury bill on the balance sheet that matures, the Fed receives a sum of cash at maturity. Even though they decide not to buy more securities with the cash, the balance sheet still holds cash, correct? Yes and no. So let's see if we can draw it out here. Assets, liabilities, assets equal liabilities. There is no equity in this particular situation. So let's say we got securities, and you have the Treasury General Account, and you have reserves. We'll just make it really simple. And let's say there's $1 billion. Securities would go down by 1 billion, and you're right, cash would go up by 1 billion. The TGA drops by 1 billion. So securities drop by 1 billion, TGA drops by 1 billion, which means we're out of balance, right? Because we only have our assets. Because the Fed is not going to be buying any more securities, somebody somewhere must buy it. The Treasury will issue securities to retire maturing securities. Somebody somewhere must buy it. Because somebody somewhere must buy it, reserves have to drop. So there is the offsetting transaction that you need. In the end result is the whole balance sheet decreases by the amount of runoff. What else do we have? I'm curious on your opinion on Google and its position in this environment, especially given its enormous current access to data. What do you think about Google? Yeah, it's got a lot of data. I don't know that it's in the business of selling its data. I think it's going to own its own data, but the question is too big. What my opinion is, I haven't thought deeply enough about it to have an opinion. What do you think about more economical chip makers such as Intel? Training AI models rely on higher octane chips. Once that phase is complete, the inference phase is less computationally intensive, so perhaps more affordable chips. Yeah. I don't know that there's much to answer there. I think you've answered your own question. Previous video mentioned that the yield of an underlying is embedded in the puts, not the calls. I'm not sure I understand that. Could you elaborate? Well, I could do it two ways. One way is just verbal, is every time a stock pays a dividend, it drops in price. So if there is a put expiring over here, and if we're doing it in sort of time, it's going to account for the fact that it's going to drop in price. So the premium on the put would be higher, so that if you're buying the put, if you're going to be long the put, you don't get a benefit by the stock dropping because of dividends, because you're going to have to pay for at least that much. So you're already paying for the drop, which means when you're selling the put, you're getting it. So if we think about it in terms of what a call and a put is on, let's just start with non-dividend paying stocks, and we'll just contrast the two. The call is equal to the spot price minus the present value of the strike price. And of course it's probabilistic, so it's multiplied by ND1, and this is multiplied by ND2, because it's, again, probabilistic. If we had a dividend paying stock, what changes is we multiply E negative lambda T. So this will be at a lower price, multiplied by ND1 minus the present value x and d2. Well, what's that going to do? So you have a number here minus this amount. You're going to be subtracting the same amount, except now this number here will be lower because the stock price will be decreased by the present value of the continuously compounded dividend over time, which means the call value over here would be lower than the call value over here. Let's look at the puts. A put is the opposite way around. It's the present value of the strike price multiplied by a probability. This time, instead of n d2, it's n negative d2, minus we have our stock price multiplied by n negative d1. Now let's add an option. This term stays the same, minus here we have e to the negative lambda t and negative d1. So you have some value minus another value. Here you have the same value minus a lower value, which means the put would be higher. So you have a combination of a lower call and a higher put. So a synthetic long at an ATM at the money synthetic long should give you an amount. You should receive the sum of the continuously compounded dividend, the sum of the present values of all of the dividends, the continuously compounded dividends over that period of time, because you'll pay less for the call and you'll get more for the put. You're buying the call, which will be cheaper. You're selling the put, which will be higher. Maybe a lot more detail than what you wanted, but there's a mathematical answer and a verbal answer. My question is on EFFR. How would you trade the Fed funds futures? I believe it's Q. What is the ticker for Fed funds futures? QC? QZ? Is it QZ? QZ. I don't have my iPad. Oh, I have my iPad here. Hang on. Let me just click on Interactive Brokers here very quickly. Let's go to fixed income. ZQ. Sometimes I have brain seizures. ZQ is the ticker for your Fed funds futures. And it is of the form 100 minus R. So if the Fed funds futures is 5.33, it'd be 100 minus 5.33, which is 94.67. So if by December you think the Fed funds futures is going to be 3.5, that means the December contract should be 96.5. So if it's 95.4, you would go long the contract if you think the overnight rate is going to drop by more than what's implied. Just realize that with IBKR, if you have a long call and want a short call to create a horizontal or vertical spread, even if it's a debit, you still have to have margin. Well, the margin on spread is the spread, right? That's all it is. So if you create a $5 spread, your margin is $500. But yeah, there'll be a margin to the extent of the spread. That's it. I hope all is well. I have a question about portfolio margin accounts. Don't know if I'd call them portfolio margin accounts. They're margin accounts. I think what you're talking about is portfolio margining, which is a different type of margining than position margining. And for that, you need a certain size of account. In the applied series, would you opt to use a portfolio margin account if you were able to, since you are using a well-diverse account which can give lower margin than using a data allocation? If I'm correct on my reasoning, can you give a slight example on portfolio margin accounts? So what it's based on is the amount of beta exposure that you would have, and your margin would be based on that, because some of your positions may create natural hedges, and it attempts to take that into account. But you need a certain size of portfolio, which at the retail level, I'm not sure many would have. Why TLT should be affected by the Fed rate decision in the short end of the curve? Its duration is 20 years. Its duration is, we don't say 20 years. We don't say duration 20 years. You can say its maturity. You can say the minimum maturity is 20 years. Duration is not a measure of time. Macaulay duration is a measure of time, but is not very useful. If we're using effective duration or modified duration, it is a sensitivity, not a measure of time. It is a measure of the percentage change in the portfolio for a given change in rates. So we wouldn't say duration is 20 years. We would say duration is 16 point. I think it's 16.8, 16.9. Capital market curves should reflect future growth and inflation expectations. Well, that is true. But the long end of the curve will also shift based on changes in interest rates. So if we think that we're at the top of a rate hiking cycle, and that our next moves are, after a period of going sideways, we're going down, there's probably limited upside to rates other than, your bear steepener, but I don't know that you're going to get a 100-point bear steepener unless the idea of rate cuts are simply taken off the table. So that's why I feel that based on the Fed being at the peak of the rate hiking cycle and rate cuts coming, that I don't think that the long end of the curve is going to get into a wicked bear steepener, given that the economy is doing pretty good. Without inflation really coming along. Oh, it blips here and there, but nothing goes straight down. It does this kind of thing. Right? It always does this kind of thing. So we've had this, and then we just had one of these, and we'll continue on. In the end, everything is probabilistic. All you can have is a feeling of probable outcomes, a feeling of certainty about the probabilities, but never a deterministic outcome. Can you explain why you chose this particular setup in order for your market updates, rates, CB stuff, real yields, break-evens, housing markets, bond? Well, the housing market is affected by rates. Once you know where rates are, where are they going? That's the next thing, right? So looking at what the risk events are for rates, which is usually central bank stuff. I don't know that there's a purpose to it. I think going through that gives me some idea of, well, not so much some idea, but kind of gives me, I guess, a foundation. It doesn't really help me with stock picking. I'll say 10 years ago, I never would have started that way. Because 10 years ago, there was nothing to see in rates. There was just nothing to see. But it is front and center. It is the story. You can't go a day without talking about yields and the Fed. It's everywhere. But in 3 years, I may not even be talking about it. I may be starting with data about where we are on durable goods, retail sales, housing sales, auto sales. I may be looking at the big durable goods indicators in the economy. That may be more important than rates, but right now it's rates. If I buy a bond with a yield to maturity of 5% and hold it to maturity, my understanding is you will only earn the 5% yield if coupons can be invested at the same 5% yield. If in the event coupons are not reinvested, how would you go about calculating yield to maturity? Same way. Yield to maturity is a money-weighted rate of return. So it is based on, if you have a timeline, you have money out, then you have money in over a period of time, right? So these are all your coupons, and there's your principal plus coupon. And you're just waiting the money. So if you get your coupon and the coupon goes somewhere else, your internal rate of return will equal the yield to maturity at which you originally bought that bond, no questions asked. You will get that yield to maturity. However, portfolios usually don't work that way. portfolios usually work that when you get the coupon, you have cash that builds up, and that cash is reinvested over a period of time. And at some future time, you say, okay, now I can take disbursements from my portfolio. But usually, when you have a portfolio, you don't siphon off the cash flow every month. You leave it in there, so that if you think about beginning value, and you think about ending value, and you're looking at all of your particular cash flows, that your yield to maturity over this whole holding period will equal your original yield to maturity if and only if each of these cash flows are reinvested at the yield to maturity rate, right? Because if they're invested lower, then your total holding period yield to maturity, your internal rate of return, will be different than what you had projected, simply because the interest rate at which you reinvest may or may not be 5% or whatever percent it is. So to be clear, if you take the cash flow out every single month, you will have a yield to maturity that equals the original yield to maturity, period. But if you leave the money in the portfolio, and then you look at how your portfolio performed, your portfolio then becomes a mix of bonds and cash. Well, you want to deploy that cash, so if you're reinvesting at yield to maturities higher than the original, you'll do better. If you're reinvesting at lower yields, you'll do worse than the original yield to maturity. So that's all that is saying. How would you play the Bank of Canada cutting rates since Canada doesn't have bonds that are easily traded? Well, I don't know that I would say that. It's a smaller bond market, but it's a smaller market. You can get Ontario bonds. You can get like provincial bonds and government bonds, money market securities fairly easily. Not as much liquidity as the U.S., but then again, we're a smaller, Canada is a smaller country with smaller portfolios. Question regarding spot rates and par rates. In one of your slides at level 1, you said that par rates are derived from spot rates. Level 2, you teach us that we get spot rates from par rates. Oh, it depends on what curve you're looking at, right? Some instances you only have spot rates. So take SOFR, for example. You have a bunch of spot rates, but we have to create a swap curve, right, to price out swaps. Well, how do you get the par rates for the swaps? Swaps are not publicly traded. There's no, you have to calculate it from the spot. So you would take your spot rates and you would bootstrap them to get your swap curve. You can draw out your swap curve. In treasuries, we are given a par curve. The treasury gives us what's called constant maturity yield par curve. And from our par curve, we can calculate our spot curve. You can go one way or you can go the other. Also in the treasury market, these are interpolated. The constant maturity yields are interpolated. You can look at zeros. There are lots of zeros. There are coupon zeros and there are principal zeros. And usually they're every 6 months, sometimes they're every 3 months that you can find them. Well, if you have, let's say one that's maturing in 12 months, you usually should be able to find one maturing in 15, one maturing in 18. Well, look at your 3-month rates between the two. You can imply what the 3-month rates are between them. You can calculate forward rates, you can calculate spot rates. If you start with 3, 6, 9, 12, you can calculate what each of the par rates would be from those zeros, and those zeros are all spot rates. So if you start with a bunch of zeros, you got a bunch of spots. You can build a par curve. If you're given the par curve, you can find the spot curve. For other than treasuries, when you do not have a par curve, you can't observe a par curve. All you have are spot rates. Well, you can build a par curve. It depends on what you're given. But you can start from spots and create a par, or you can start from a par and create spots. You can go both ways. On the financial sophistication argument, which is an example you've given us, is sophistication of corporate finance departments to neutralize duration on their long-term debt by entering in swaps. Question is, firstly, whether this really has zero effect on the economy. Yes, the company could immunize variable rate debt with the swap, but the counterparty of the swap would be taking losses. the counterparty of the swap is usually your bank. And your bank is an intermediary, right? So you have a swap over here, and let's say you are paying floating and receiving fixed. Your bank over here is the opposite of that. And of course, it's going to try to find a counterparty, and maybe you have a large swap of $1 billion. It'll try to find a bunch of different counterparties that are on the other side. Now you may think, well, what is this counterparty doing? Well, for every bank, there's a corporation, right? So a bank wants to lend money at the highest rates possible. So if it believes that rates are going up, it may enter into a receive floating, pay fixed swap. Whereas there are companies out there that have a loan with the bank that don't want interest rates to go up. They may enter into a pay floating received fixed. Receive floating, pay fixed. Well, those would offset. So there's a whole bunch that want to be on one side of the swap for whatever reasons they are. There's a whole bunch that want to be on the other side of the swaps. Keep in mind, one company's liability is another company's asset, right? So they may be motivated to lower the cost of their liability, and they may be motivated to increase the value of their asset, and the bank sits in the middle and says, well, we can help you out. So there are two counterparties. You may say, well, the loss of one is the gain of the other, which is true, but the loss on one is exactly what they want, and the gain on the other is exactly what they want, because they're on opposite sides of the balance sheet. And so they need to be on opposite sides of the derivatives, thereby both of them winning by transferring the volatility of each other's. So what it's doing is it's transferring the volatility of the asset over here and the volatility of the liability over here. So when you net them all out, there's very little exposure. Whatever exposure is left over, the bank steps into the market and hedges that out with other counterparties that are doing their own thing for their own reason. Okay. Where's my mouse? There it is. Let's see. Could these losses be accumulating in the financial sector and spill over? Someone has to take the hit. They try not to. The bank is not there to be the casino. I mean, the bank is not there to be the player. It's the casino. So it's going to try to run as balanced a book as it can. When the swap reaches the expiry, eventually the companies would have to re-enter the swap, this time at worse fixed rate. Do you think this interest rate shelter companies are enjoying this time limit? Well, that's the point, is there is less interest rate sensitivity because you can hedge out for so long. But yes, they do roll over. So every quarter, there are some companies who had, 5-year swaps that they put in place in 2019. All the 5-year swaps that were put in place in 2019 have to be rolled over. They are going to roll over at higher rates. But if I had a swap in 2019 to keep my interest rate low, and I'm looking at rolling it over now, why would I even do that now? If I think that rates are going to go down on their own, I would just say, well, if I had fixed rate debt, I would probably do it if I had floating rate debt, but I'd probably just not hedge at all. If I think that interest rates are going to drop, just let them drop. As soon as your swaps run out, you got to roll them over. Could you please elaborate on what are the reasons for such a significant increase in capital market yields since the beginning of the year? Well, it's a bear steepener. We pushing 60 days since the beginning of the year. I think the 2s to the 7s are up like 40, 45 basis points. The longer end of the curve, less than 25. I think that's normal considering the massive drop in yields we had going into the end of the year. It's a natural adjustment. I often get confused in analyzing the relationship between price of corporate bonds and their risk spread against treasuries. If the risk spread widens, does the price of corporate bonds go up or down? Holding everything the same, if the spread widens, the price drops. If the yield of the 10-year US Treasury goes up, does the price of a corporate bond go up or down? Holding everything constant, if yields go up, the price goes down. Do you think it makes sense to have some S&P or tech equal weighted allocation at this point? No. You know, timing markets is really hard, and I can't answer that question unless I ask you what your motivation is, what your time horizon is, what your plan is. If you say, well, I plan to contribute every quarter for the next 20 years, then it doesn't matter what time you buy. Trying to time it is going to be really difficult. If you say, well, I'm really trying to get something going over the next 6 months, I'd say, well, the T-bill rate is great. Take that. Don't try to time the market. But if you have a long holding period, I don't think it really matters. Equal weight, I think, protects you from the sheer weight of some of the companies in the S&P right now. I think the top 6 or 7 are making up over 20% of the index, which means you've got a lot of concentration risk. As a measure of liquidity in the system, should we care more about reserves held in the Fed than the total balance sheet? I'd look at reserves first, yeah. Since March 8th, just before Silicon Valley Bank collapse, total Fed balance has shrunk 9.2. I think a little more than that, but okay. 9.2 seems light. It went from what, almost 7.9 down to 7? More like 11% maybe. Same period, reserves in the system soared 17.3. I think it went from like 3 trillion to 3.5. Okay. But you're also forgetting the reverse repo went from 2.5 trillion down to 0.5 trillion. It lost 2 trillion on the reverse repo. So that probably accounts for the differences in those two numbers. What is your view of U.S. small caps? I think challenged when interest rates are very high. They have not run up. Yeah. Still far from all-time high. Yeah. They stand to gain the most from the rate drops. Do they? How should I go about analyzing the broad market of small caps versus SPX? About 2 years ago, and I can't remember what video it was, but I remember saying that I think that we are entering into a period of large cap dominance. That the place to be over the next, so many years is going to be in the large caps, especially with even more so now with AI. They're better positioned just with the sheer amount of data they generate. They're better positioned to get something out of that data. Maybe not. Maybe the idea of I got a whole bunch of data, I'm going to do very well with AI. It could be that your data is meaningless. It could be like, well, I mean, your data is not really saying anything you couldn't figure out yourself. It's not complex enough. There isn't a network effect in your data that you could figure out. Some companies may have data that they produce a lot of it, but it's like, well, what are you going to do with this? What can it tell you that you probably don't already know? So I don't know that small companies generate enough of that, and generate enough data, and because of that, it may be that they're just not getting a bid. I don't think small caps will start to really perform until rates really start coming down. When you're in a confirmed bull market and you know the Fed has your back, what is the preferred way you add leverage to your positions? Options, mostly options. In the financial sector, in the sector studies applied series first video, you mentioned you have a writer from the Federal Reserve for financial sections. I did. A couple of weeks after that, I believe I put up, I was talking about one of the normal videos I put up, that they could not get permission. So if you work for an organization, you can't just do what you want. If you say, look, I'd like to teach somewhere, it's like, well, teach where? What are you going to be teaching? What are you going to be saying? I'm going to be on this podcast. What podcast? What are you going to be saying? I need to know what the questions are and what you're going to be saying, and then we'll clear you for it. So if you work for any kind of significant financial organization, you can't just go saying whatever you want, wherever you want. You have to have it cleared, and couldn't get it cleared. So I did it myself. I know you always preach only trading underlyings with liquid options. And I seem to remember one of your applied options videos, you mentioned a rule of thumb you have around when an options bid-ask spread is too wide to trade or not, but can't seem to find it. Something like you won't trade a particular option, the spread width is over 15% of the ask. 15% is still pretty wide. $100 stock, $150 spread, that's way too wide. Usually 30 cents. Once you start getting past 30 cents on the spread, it's unless it's a very high-priced stock, like a $200 stock, and you got a 50-cent spread, yeah, it's not really great, but I can live with that. But if you got a $30 stock and the spread is 80 cents, not interested. You might be able to get in, but good luck getting out, especially if you got to get out quickly. That spread will widen if you got to get out quickly, because whatever is causing you to get out quickly is heightening risk, and that spread will widen. Trying to decide if I should have my dividends for companies the agency and ABR reinvested, or if it's best to take the cash and wait for better prices on my securities. Do you have your dividends set to reinvest? I used to have the drips, because it was just easier, and I knew I was going to hold something for a period of time, and I wanted to reinvest them anyway. So I thought, who cares? It's a more efficient way of getting the compounded return, is just to get the shares. So I used to. I don't have any that I do it to anymore. I don't think it really matters at high interest rates. At low interest rates, cash is not worth anything in your account, and you may get such small dividends over time that you can't really deploy it very effectively. That, if your drip gives you 7 new shares, you're not going to go and incur the transaction costs of buying 7 new shares. So it just gives you a quicker reinvestment using the drip. In anticipation of lower for longer rates due to debt to GDP in Canada, it would make sense to enter trades in certain interest rate sensitive CAD industries. Well, industries, let's change that to securities, because depending on what makes rates go down may take the economy down, may take those industries down. Bonds, real estate, I'd stay away from commercial real estate. I'd only be in REITs. Bonds, REITs, yeah. I would have to know what is taking rates down to be able to answer that question. Because if it's the economy that's taking rates down, then I wouldn't want to be in any securities that have risk. Could you explain what is gross value added? This is a form of GDP accounting that India has adopted. How is it different from GDP? So take an economy that has no product taxes or no subsidies. GVA equals GDP. If you have an economy with a lot of that stuff going on, maybe gross value added gives you a better idea of the activity that's going on before you account for the taxes and the subsidies, because the taxes and the subsidies may distort the number that you want. I don't know enough about the Indian market to know whether taxes and subsidies are an issue. If it's not using GDP and using GVA, it's probably because there's some distortion in either the product taxes or the product subsidies that make GDP not as reliable or good an estimate as GVA. It basically is just another way of counting GDP. Wondering what your take is on the increase of issuance in IG and high yield debt year over year. Don't know that I have a take on that. I think companies are simply just getting on with business, saying, well, we've waited, it's been 2 years, the Fed is doing what it's doing, and maybe some companies feel that, credit spreads are so low at this point. Why not take advantage of the low spreads? And they can always use derivatives that when interest rates drop, the derivatives pays off, right? But to get this spread, this nice tight spread, let's do this now. Would your trading strategy be different if your capital was less than 100K? It would be smaller. It wouldn't be, I don't know that it would be different. I'd use the same strategies. I just have much smaller positions. Would you consider synthetic long on TLT a relatively safe bet? Well, it's relatively safe. I mean, relative to what? When you say relatively safe, relative to synthetic long on the SPY? Safer, sure. Maybe even a risk reversal if things go south on a hot PCE reading or during Powell's speech after Fed meeting. New FOMC projections. I have long duration exposure already in my portfolio, so I'm looking for a way to boost the potential gain. Although I invest in equities long term, I don't have the courage to add more exposure. Certainly not at these multiples, but I have been saying this to myself for the past year, and boy was I wrong. No, not just you. This market is defying everybody's expectations. It just keeps going up. A synthetic just means you're getting a delta of 1 at a lower cost. It just means you can control 100 shares at a lower price, sitting at 93 and change right now. Over the next 12 months, is it going to trade higher than that? Yeah. Will it trade lower than that? That could be. Where is it going to be in January? I don't know. But the path to get there, I think, has some rallies in it that could be enough to, strategically jump in and out if you want to try that. I don't know what the end, where we would end in January. One more question. Do you think long term Triple Q can outperform SPY XLY? On the XLY QQQ, that's a tough one. Outperform SPY, yes. XLY can outperform SPY. We say over a 10-year period. Sometime in the next 10 years it will. But in 10 years' time, the global economy could be complete crap. Everything could have fallen apart and we could be lower than we are now. But, at some point over the next 10 years, we're going to be higher. And I think that tech will continue to outperform simply because technology finds its way into our lives more and more and more. So I think it continues to outperform. In your answer to candlestick question, you look for inverted hammer. On the rate screen, you said the Fed would need to cut 75 with some conviction. The Fed has forecast 75 basis points. In the context of the American economy being less sensitive or insensitive, wouldn't that make an argument against the need for such cuts? Well, it's about inflation, right? I mean, if the economy has been insensitive to changes in rates, but inflation has come down because it's a supply solution. The increase in interest rates, I don't think, did very much because of the insensitivity. It was the repair of the supply lines. Had they kept interest rates low, I think inflation still would have come down. And in fact, I think there probably would have been more supply sooner because supply has to be financed. And at higher and higher rates of financing, you're actually deterring supply. I think you would have had it solved sooner and faster. especially because it was supply driven, if you just left rates where they were. If it were demand driven, then yeah, you gotta get demand down. But getting demand down doesn't get supply up. Raising rates really only makes supply harder. I think they prolonged the process by raising rates. Can you share your argument why you feel 3 cuts is almost inevitable? I don't feel that 3 cuts are almost inevitable. I think more are inevitable. The Fed is at 3. Would you change your answer position if the Fed is able to truly manage being apolitical? I think they already are apolitical. So I don't think that they have to become apolitical. I think they already are. I'm reminded of a video you put out years ago at this point regarding credit spreads. We're continuing to see those credit spreads tighten. Yep. Doesn't seem like IYG at all even cares about the current situation. Nope. Do you think this is contributing significantly to equities churning higher? Well, it's certainly a vote of confidence. I don't know that it's contributing to equities churning higher, but when you look over at credit spreads and the credit market is going nothing to see here, at least the equity market says, okay, well, they're doing their job, they're doing their homework, and they're not concerned, so okay. But when you see credit spreads widening, you think, whoa, what's going on there? What do they see that I don't? But they're not seeing anything on that side, and you have to think that they have some fundamental analysts over there looking at this stuff saying, we see nothing. So it's a sort of a vote of confidence. If credit spreads are of any significance, what do you think might break first? Will the equities come down in price and then spreads widen? Yeah, if there's something significant, they'll both happen at the same time. Money will just flee out of risk assets all at once. It's not going to, it won't be sequential. Need a Q&A for level 2 May candidates. I don't do those. I do the level 3. With regards to building out discounted cash flow model, what are your thoughts on lowering the discount rate over the valuation period? If you're dealing with a mature company, then no. You have, in the S&P 500, I don't know that I would be lowering the discount rate over the forecast period. These are mature companies. So no, I don't think that I would be doing that. Is this an acceptable practice? It would for a rapidly growing company that is, transitioning to a lower growth rate in the long term. But is NVIDIA that kind of company? Or is it simply taking advantage of a surge in demand for something at this point, but that's not really its growth rate? That once this surge in demand is done, it's going to go back to its particular growth rate. I don't know that I'd be lowering the cost of capital. Bearish candles alone are not particularly meaningful. Usually you'd want to see a follow-through candle to the downside as confirmation of a local top. Especially if we get confluent piece of info like bearish divergence or similar. I'd say the recent bear candle was invalidated by the following green week. Well, yes, this is why I don't like this stuff. It's like, everybody sees what they want when they look at these things. What do you think of the box ETF? I'm not familiar with it. Looks very interesting from a tax perspective. Money market returns with no taxable income. Only capital gain when you say, that's not true. It depends on what country you're in, right? 60-40 rule. It's probably using a box trade to get that done with options. So it's a bull spread and a bear spread overlapped. And what you're hoping is that the spread amount is, well, first of all, it's going to be greater than the cost of the options that you're buying. And the spread amount is at or greater than the risk-free rate for that period of time. And that's what you're really looking for. I mean, you're going to get that. You're going to get the spread because, it's going to be, you're boxed. So you're going to get something, right? Um, that generates 60-40. 60, I think it's 60% long-term capital gains, 40% short-term capital gains, and the capital short-term is taxed as income. And because it's an ETF, when you get your statement at the end of the year for how the dividends you received are treated, you'll find that some of it is considered long-term, some of it considered short-term. It will still be more tax efficient than receiving interest income, but not completely. Like you're still, it's only 60% of the difference, but still, you know, it's enough. Nice when you have 5.5% T-bill rates, but it's really not very worth it at all if your interest rates head down to about, 1% or 0.5% on money market rates. Questioning on managing portfolio margin. Say you're running 50,000 theta sleeve. Let's assume you only have 50,000 total capital, want to allocate it all to theta. Let's also assume you set up so you're close to delta neutral, but you aren't all on one side of the options chain. Would you set up a rule that you need to have X% of your capital available to manage margin? Well, you better have something for margin. You better. Understand that you can earn the T-bill rate on cash in your account, but any uninvested cash would be a drag on performance. Running out of liquidity would be a bigger drag on performance. You got to keep something in there. But if you're the closer you are to delta neutral, the more the closer you can be to I wouldn't say zero cash, but the closer you could be to a low, the lower your cash balance can be. Wondering how to manage to trade up between efficiency being fully allocated and making sure you have the capital handle swings and margin. Because you have $1 million to play with. Well, you can reset your IB account to 50,000. You don't have to take the $1 million. You could reset it and set it at 50,000 and do some testing on your own. Q4 year-over-year SPX revenue growth 3.4, surprise factor 1.1. Using the GDP inflator 2.6, wouldn't real revenue growth be 0.8? Yeah, I focused on the 1.1, the surprise factor. I wasn't thinking you had to use the full revenue growth. Correct. I know you're bearish long-term rates, but imagine you were looking for a hedge against hypothetical raise in long-term rates for the next year or two. What would be the most optimal expression of that hedge using options? A raise in long-term rates for the next year or two. Raise in long-term rates. That's a good one. I don't really know. I kind of think that just sounds damaging overall. So I don't have anything on that. With financial sophistication, players in the markets can immunize themselves from changes in interest rates. The counterparty energy. Okay, I already answered that. Any thoughts on coal? No, I don't really look at it. No thoughts on it at all. FRM level 2 student want to ask if equity, interest rates, and sectors which most relied on interest rates are all-time high. Well, housing prices and housing stocks too are up there. Auto's not at all-time highs. As you mentioned, this can be attributed to the use of structured products and various hedging instruments which are in place. As to every trade, if one party gains, the counterparty suffers losses. Most of the counterparty are banks. Well, the banks are counterparty on both sides, as I've said, so they usually try to run a balanced book. Do you think that keeping the rates higher for longer will create a problem for banking sector? Not in the way that you're thinking about it. Not because of derivatives. No, I don't think that higher rates for longer means that banks are taking losses on all these hedging instruments. No. How How are or will going to recover the losses from these hedges? Well, yeah, okay, so it's all premised on the fact that the banks are taking all the losses and they're not. Is the U.S., if the U.S. is the biggest financial market in the world and the rest of the world invests in the U.S. because they want to share the return, how can the GNI be greater than the GDP? Well, then your first assumption would have some fault in it, right? When money is transferred out of the U.S., there's always withholding. So the withholding tax can minimize the difference between that. The U.S. net international investment position is negative. Should that make the GNI smaller than GDP? Keep in mind you have a whole bunch of corporations, 40%, 45%, 50% of the S&P 500 revenues and profitability come from outside the U.S. So all of that comes in. So while you have outsiders holding shares, most of these companies have international footprints and bring money into the country. So yeah. Isn't Japanese equity market pronounced Nikkei? Yeah, the Nikkei. Okay, yeah. Wondering if you would be open to adding a financial modeling course to the applied series this fall. Nobody answered that. This fall. I just don't know what company I'm going to do. Don't know if I'm going to do DHI, which is a simple company, or try something a bit more complex. I think Tesla has some nuance to it that is worth exploring. You can't discount all of those cash flows at the same cost of capital. You have a car company at the heart of it, use one cost of capital. Everything else, the robot and autonomy, self-driving, robo-taxis, these are venture capital. Those should be discounted using venture capital discount rates 50%. Not the 10 or 11 or 12% cost of capital, but 50%. That would be reasonable. So it's a good example of how you would use multiple costs of capital within an organization using like a project cost of capital, because the project they're working on is so far away in terms of risk than their core business that they're in. Any thoughts on investing in Pakistan? Zero. I know nothing about it at all. I think I missed one question above. NVIDIA has held leadership position in its gaming GPU segment for a long time. By the time its rivals catch up, NVIDIA is on to something bigger and better. NVIDIA is superior in both hardware and software. NVIDIA continues to integrate AI-driven features into gaming GPUs, most notably all of those letters. I'm a long-time NVIDIA consumer. A comment as opposed to a question, good, because I don't know that I would have an answer going into the detail of these features. And there we have it.